Hello, welcome to Advisor Q&A. I'm Tony Kay. Firstly, I just wanted to apologise to listeners. We've had some technical problems today and we weren't able to do the live broadcast, but we are pre-recording this and we will address all the questions that we received. If you do have any questions which we didn't get to today, then please feel free to send them in and we'll answer them directly. I just wanted to introduce our usual panellists, Bruce Bramall.
Morning, Tony.
Hello, Bruce, and Max Newnham.
Happy New Year, Tony. A bit late for that, but better late than never.
Happy New Year. We've got the new year starting, and what better way to start than to look into this legislation that's coming into effect. It's actually a big one. It's got a lot of interest from people, and it's the downsizing legislation coming in July. We've written a bit about it, but there's actually more to this than meets the eye in terms of some of the ramifications of how it may work for different people. So I wanted to start off firstly just by going through exactly what the legislation is, and then we can get to some of the questions.
I think we've got to work out, let the listeners know that we've drawn straws. Bruce is going to be bad cop, I'm going to be good cop from that point of view, but it's something that has to be looked at carefully. There are costs, and Bruce can, I think, explain a lot.
I want to be a bad cop as well, but right. I'll defer to Bruce on the bad cop.
Good.
So let's start, Max. Perhaps if I go to you, because you've written a couple of recent articles, and I know Bruce has, but just to outline exactly what the legislation says.
I guess, like a lot of things, what was originally announced as a downsizer contribution and what we've seen that's come out in the legislation, it could be called the top-up super contribution because there is no definition of downsizing.
There's actually no requirement.
No, downsize. So you could be selling a little place in the western suburbs and moving to Toorak or Piper Point or wherever is a more salubrious location into a mansion. You'd still be able to use the proceeds of the smaller residence to get into it, and that's probably worthwhile going into the major, or there are 7 rules effectively that you must be able to meet, or tests you must meet to be able to make the downsizer. The first is you've got to be 65 or older. The contribution of the proceeds has to come from the sale of the house. It can't come from anything else. And even though there's a $300,000 maximum, if you sell a house and there's a couple that they sell it for $500,000, the maximum between the two of them is $500,000. So it's a $300,000 maximum, but limited to the proceeds of the sale of a house. The house has to have been owned for 10 years. There's some interesting flexibility in that. We can go into that later, but the house has to have been owned for 10 years. The important thing too is to be a qualified sale of a dwelling, it needs to that the proceeds of the sale have to have been eligible for the principal residence exemption. And the principal residence exemption only relates to homes, someone that calls their principal place of residence, which is a term they used to use. But it's interesting, under capital gains tax law, the definition extends to a number of different structures. This legislation is requiring that the property that is sold cannot be movable. Houseboats, caravans, mobile homes, anything like that do not qualify. So it must be a normal real estate rather than those others. And the contribution to the super fund must be made within 90 days of the disposal of the dwelling. Now, the disposal of the dwelling, I think, would have to be the settlement date, whereas under capital gains tax law, you dispose of the dwelling at the signing of the contract.
Well, it says exchange of contracts. So, it's the exchange of contracts. Would generally be at settlement.
But that'll be something that'll be worthwhile chasing up with the relevant bureaucrats for that to work it out. So there is a time frame that you must make the contribution to be eligible for. And as you'd expect, when a person or a couple make that contribution, there's a bit of form filling out where the form has to end up being lodged with the super fund saying, hey, this is a downsizer super contribution. And the final thing is, and this is where I'm not 100% sure, because the final test was that someone cannot make other downsizing contributions in relation to an earlier disposal of a main residence. All I'm thinking that can mean, because I know in the explanatory memorandum they were saying if you haven't used your full 300,000, you can make another downsizer super contribution if you meet the other relevant criteria. So on this, it must mean that if you've sold a residence and the money comes through afterwards, even though you can apply for an extension, you cannot make a downsizer contribution on the same sale that you've already used. It'd have to be another sale. So you've got to make up your mind within that 90 days, am I going to maximise my 300,000 or I'm going to make a lesser one? You can't change, oh, gee, I wish I hadn't have kept that money outside of it. So they're the 7 tests that you have to meet.
Yeah. Now, we know this legislation is coming in from July 1 this year, but obviously in this earlier part of the year, you know, it's really the time for people to start sort of thinking that want to take advantage of it and who can take advantage of it. It's really the time to start thinking now, you know, as to whether they want to get in sort of straight away or if they want to wait for a while.
I don't think there's any rush on it. You know,
there's no rush.
You're either thinking about it or you're not thinking about it. And if you're thinking about it and you're thinking about maybe doing it in the first, 3 or 4 months of this year, those people, and there won't be a lot of them, but there will be some, they want to think about whether they need to or should delay this until after July 1. I don't think there's going to be a huge rush of people going to do it. This isn't going to be something that dramatically increases the number of people who are downsizing. It will encourage more people to do it, absolutely, but I don't think it's going to double the number of people downsizing in a short period of time.
My question is, and you may have just covered this off, Max, but my question is, if someone sold before July 1 but settlement doesn't take place till after?
So Dave, in fact, your question's a good one, but the answer more is, if anyone out there is thinking about downsizing, if they were thinking about downsizing to make the most tax-effective improvement to their retirement finances, it will not make sense for those people to be signing a contract of sale before July 1. So if they want to have the ability to make this contribution, they cannot sign the contract, because it's the date of sale, and this is where we've got to get some clarification from the bureaucrats, is that it's the sale date is the date of the contract. And they, again, in these explanatory memorandum made it clear, it will only apply to contracts entered into, in other words, when the sale note is signed, when the hammer goes down on the auction, or whatever you want to do, that occur July 1 onwards. So it's more, you don't need to rush. More importantly, if you're thinking of doing it, delay.
All right, so we've got questions to answer, but before we get to them, I just really want to sort of give a bit of a bird's eye view on the pros and cons of this legislation, because there are advantages for some, but I think there's also disadvantages.
Bad cop, good cop. Yeah, we've got
exactly,
that covered. Yeah,
exactly. So, all right. Well, let's always start with the good cop. What are the advantages of being able to do this now?
If you are making a conscious decision to downsize, and it's not necessarily one that you're making purely to improve your superannuation or increase your retirement assets. In other words, in my professional work, one of the questions I ask clients, do you expect to be carried out of your current home? Or do you expect at some time that you are going to want to go from your 15-bedroom mansion down to a 2-bedroom unit? I mean, you need to think about that. And so for those people who are thinking about that and are looking at downsizing or selling, it doesn't have to be downsized, that you need to be factoring that in. So if that's what you're doing, the next thing to look at is you're going to need to either do the numbers yourself, and it's going to actually create the need, I think, for people in that situation to go and see a professional that specialises in this area, because it may end up being, especially like happens with a lot of cases, people are forced to downsize because of illness and they have to go into some form of care, or they decide they want to do that sooner than later rather than being forced into it. And then you have the refundable deposit, and if they've got a 1.5 million home and the refundable deposit's 800,000, then they've got the excess. That it's the time to work out whether is there a way of maybe having, because you can either decrease the refundable deposit and increase your day rate. So therefore you need to get the advice as to, do we not have so much go in, have more go into super, use our full 300,000 and do the numbers. So what it is for those people that were going to be selling their home, it now means that they can get the money into superannuation, and especially if they've already got a few investments outside, that if they had those investments or the proceeds go on top of their already outside investments, they'd be paying tax on it. It makes a lot of sense. It's a very flexible, it's amazingly flexible, it's not strict. People don't have to have necessarily owned the house for 10 years or even have been on the title for 10 years. Because you can have a situation where, as there's a lot of cases, people in business have the principal residence in the non-working spouse's name, and the working spouse or the ones at risk doesn't have it in their name. If you are married and your name's not on the title, it's still, you are able to use those proceeds.
Let's look at it another way. Your principal place of residence is tax-free.
Yes.
So whenever you sell it, or if you ever sell it, whatever you receive from that home is tax-free, you know. So is this legislation going to suit people who, or more suit people who have got less in their super and who are in the retirement phase? They can basically sort of extricate some of that money out of their house, put it into their super and start earning.
There's no doubt that this is an
income.
improvement on what was there. There's no doubt it's an improvement. I'm just a little concerned about how big an improvement or how many people are going to actually be able to take advantage of it. If you were 70 or 75 and you downsized your house and it did free up, you know, $500,000 or $600,000 or $700,000 worth of cash, a few people could get that into super. You'd have to meet a work test. You'd only be able to put in $100,000 a year, and you can only do that until age 75. So this allows people to put in $300,000, possibly $600,000 into super, and there's no question that is an improvement on what we had. The biggest problem with downsizing has, in my opinion, has always been the cost of doing so. If you are selling $1 million house to go into a $600,000 house, the $1 million home is going to have about 3%, $30,000 worth of costs associated with the sale, marketing and paying an agent, and advertising, whatever else. It's about 2.5% to 3.5% as a general rule. So $30,000. In order to purchase the $500,000 property, you're going to have stamp duty in Victoria that's going to be $25,000 to $26,000, $27,000. In other states, it'll be marginally cheaper. It might be $15,000 or $16,000, $17,000 in Queensland. But you add those two costs together, and you've got somewhere between $45,000 and $60,000 worth of costs of downsizing. Yep, you're going to free up some cash for that, and if you're going to get $600,000 into super, which in that situation you might not necessarily be able to unless you've got extra cash sitting outside. But it's the cost of the transaction. The cost of doing this is still, that particular example, $50,000 or $60,000 worth of costs in order to do it. Those costs are going to be there whether you did it a couple of years ago or in the future, and the advantage of this, of the new downsizer contribution ability is that you'll be able to get that $600,000 into what is either going to be a tax-free pension or at least into superannuation, You may have gone over your 1.6 million transfer balance cap already, and this money might have to sit inside inside accumulation or superannuation and be taxed a little bit. It's still generally for most people going to be better than having that $600,000 sitting in their personal names if they've got other investments, as Max was talking about, another couple of investment properties or some shares or whatever that's lifted them into above the 0% marginal tax rate. It's still going to be a better option for them in general, but yeah, the biggest downside of all this is still the cost of selling and repurchasing.
Yeah, and I've written about this. I think you may have written about it as well. But once you factor in your agent's costs, your stamp duty, even if there are some concessions on stamp duty, it really depends on the value of the property you're buying. And in some cases there are no concessions depending on where you live. So you can be up for a lot of money just going through this process. Then it can also put you over the assets test limit in terms of getting a pension.
The age pension,
yeah.
And the next column I'm doing, if it's not the next one, it'll be the one after. I'm starting to run some numbers on what the situation will be on the loss of the pension per $100,000 that a person puts in, and on the basis of that, if you didn't have it happen, in other words, and decided not to do it, what's the cost of staying where you are? I think the big thing is, and I agree with both of you, that this is not necessarily going to be a strategy that people suddenly want to take up to improve their financial position. This is a measure that's going to allow the people that would have been looking at selling their own home for health reasons, for other reasons, that whereas previously, if they didn't do it before they were 65, after they'd retired, no, it couldn't go in. It now means, and I guess it's with the old government giving with one hand and taking with the other. They've taken by reducing the concessional contribution limits, putting all of these other restrictions on the amount you can have in a pension fund of 1.6 and this stuff. That was the taking. The giving is, with this downsizer contributions, it means that, and because the downsizer contribution is now a fourth type of contribution, it is not affected by any of the other rules, whether it's the total superannuation balance, the transfer balance cap, all of those things. It just means that people don't have to, if they were thinking of doing it, and previously they were going to want to retire at 65, never wanted to work again, they were forced to do these sorts of things before they turned 65. It now means it gives them the ability to say, well, yeah, I really want to maximise my retirement income, and the best place for that is super. Gee, if I don't make these sales and stuff now, and I'm not going to want to work afterwards, and I'm going to have this money outside of super, which could mean I'm paying more tax, which is not as effective. Now they've got the ability to take a deep breath and say, let me look at this, and bringing in this fact of having an investment property. It now means, in my planning, saying to people, look, you've got your investment properties. You say you want to hold on to them forever, but hey, there's a couple of very good reasons why you don't want to do that. First one is the income that they generate is normally very low as a return on capital. The second one is, by deciding to keep it until you die, you're passing on the capital gains tax debt to your kids. So the idea could be is that when you sell an investment property, and the proceeds from the investment property might have gone into super or something, if it could have. Now, if you're selling your investment property in the same year that you sell your home or whatever, the proceeds from your home go into the super fund, and the proceeds from the investment property goes to buy the replacement. So it's really going to help those people that were going to downsize or were going to be forced to downsize or shift.
Absolutely.
Yeah.
There's little upside. There won't be too many people who are going to be negatively impacted by this. It's a definite upside for those who are either going to have to do it for health reasons or for other reasons. Big upside benefit. Will it drag too many people to do this for the sake of getting money into superannuation. The government announced this under a housing affordability package.
They did, yeah.
It was one of two strategies that was in a housing affordability package. So it suggests, or it doesn't even suggest, it says there in black and white, that one of the reasons for doing this is to help housing affordability for Australians. The second tier of that was the First Home Super Savers scheme, announced together under this umbrella of improving housing affordability. As I wrote in a column back in December when they announced this, I actually think it's going to have the opposite impact if people do it in the legitimate sort of way, selling their $1 or $1.5 million home to buy a $600 to $900 or $1 million property, whatever they're downsizing to. For the majority of people doing that, it's going to put them back into first home buyer territory again. That's increasing demand for first home buyer property.
They'll be competing against first home buyers in that lower end of the market.
What does that do? You push up prices. You put more demand into it. It's more likely to increase prices. The same thing, sadly, for the First Home Super Savers scheme is that you're also increasing demand on that side for the other end of the age spectrum, younger people looking to buy their first home, by increasing their deposit and savings. And so I think this housing affordability two-pronged is actually going to have exactly the opposite. It might not even be overly measurable, but it often tends to be that whenever governments get in to try to help with affordability, it's the unintended consequence, but it tends to make things worse.
Yeah. And I think the thing to be sending out a real note of caution, and not that I would be accusing certain industries of trying to profit from changes to legislation and so-called things, be very wary of offers that come through in the mailbox about saying, now we can end up helping you get a great, boost to your retirement savings by if you sell whenever.
It's inevitable.
It is inevitable, but you must, unless you want to be like the lamb being led to the slaughter, you must get some form of advice, because if you don't, it's going to end in tears.
No, it'll happen, and it'll start to happen, I would guess, in probably April or May, that you'll start seeing flyers in the letterbox saying, we can help you boost your super and decrease your running your house costs by it'll happen. It'll happen.
By the way, we can actually help you with the financing of maybe for when you're getting into a new place. And we actually have a referral to a very nice gentleman who works for one of the major banks who'll get you into one of their very good super funds.
All right. Well, let's get into the questions now. We've covered off a fair bit of ground there. I suppose the number one piece of advice there is to get advice. Don't just rush into this. You really need to look at your circumstances clearly and speak to a financial advisor on this. Right. So we do have questions. Again, sorry about the technical issues that we couldn't proceed live today, but we do have questions in the can ready to go. So this one was from Glenn. Glenn asks, will the 10-year ownership qualification apply from when he purchased some land, or is it only when he's constructed the dwelling and he's got a certificate of occupancy?
It's when the property becomes the principal residence. So if Glenn bought the property 10 years ago, he's held it there ready for him to build his dream home on. If Glenn finally sells his house after the one he's living in now, sells the house, builds on the property, that property, the land, doesn't become his principal residence until he shifts into it. So no, I don't believe it would apply. It has to be, unless he's erected a tent and he's been living very rough since he bought the block of land. I don't believe that would, and if it was somewhere within a loophole in the legislation, that'd be closed so quick. I mean, they're already being very generous from a point of view of someone can marry someone else and be married for a week, and if their partner dies that had a principal residence for 10 years, they get ability to have the downsizer contribution. So it's very flexible in those areas, but I can't see it. It's got to be a residence.
It's got to be your principal place of residence, and which it can't really be until you're constructed.
I like the way Glenn was thinking that. I mean, I think it was a...
Well, yeah, you've got to ask the question, don't you?
That's right.
Now, you've really just answered the next question anyway, I think. But Robert asks, he and his wife have lived in a home for 20 years, but his wife is the only name on the title. Is he still allowed to do this?
Yeah.
That's the other thing. As long as, if you are a couple, and interesting enough, even before the momentous change in legislation, which has seen a great boost in the wedding reception business, that under the Tax Act, couples were recognised of whether they were the traditional couple or from the same sex side of things. So in that case, it just now means that with the new legislation, there can be no equivocation. They're definitely a couple, and it applies. So
there's no mention in those it's roughly 7 basic rules of qualification for this, that the title needs to be in the name of both members of a couple. And specifically so, because so many people have it in just the name of the husband or the wife, but it's it's known to be a joint asset. But for asset protection purposes, it's in one member of the couple's name. So all the rules that have been written seem to suggest that actual ownership title doesn't matter. Both members of the couple will be able to use the 300,000.
The interesting thing where it wouldn't work, and it often happens with second marriages and things like that, especially when there's two families and step-family situations, the proceeds of the sale of the residence must be what is contributed. So where there is a will in place, where the surviving spouse is looked after in another financial way, rather than being able to use the proceeds of the sale of the principal residence, they wouldn't be able to get it. Because there must be the direct nexus between the sale proceeds of the house and the contribution.
Just a variation on this, I've got a question. If a couple is a de facto, it doesn't matter. So under the law, they're still a couple.
So long as you're legal de facto, which probably differs a little bit between the states, but 6 months or...
Yeah, I've had a few clients that have been quite shocked when they realise a de facto relationship gets them into the family court just as quickly as if they'd gone and signed the documents.
Yeah. All right, the next question's from Charlie. Charlie's got over the 1.6. He's looking at the downsizing legislation, but he can sell his principal place of residence, buy a new place just using money that he's got outside of super, and put the proceeds into super. Is this going to impact the transfer balance cap? Does it have to go into accumulation?
Well, if you're over the 1.6 or you've used up your 1.6, then you can still put this money into super, but it will sit in accumulation, so it'll be taxed at 15%, maximum 15%. But the money can still go in, but unless you've got room in your transfer balance cap, it's going to have to sit in there. Now, that will work for a lot of people. A lot of people with bigger incomes or assets outside of super that are above the 18,200 tax-free threshold. If they're earning 50 or 100 or $200,000 outside of super already, then getting that 300 into super means it's only going to be taxed at 15% versus somewhere between 19 and 47. So it'll make sense for people to do it even if they've already used up their transfer balance cap.
Yeah. So it's very much a tax question then, in terms of what adds up, what stacks up.
It was this point. Prior to this, we had 3 types of contributions: concessional, non-concessional, and small business CGT concessional. The small business, when they brought in the new rules of the 1.6 and the reduction to 100,000, all those sorts of things, they made it very clear that the small business CGT concessional contributions were not affected. All of the rules that applied to them with a $500,000 lifetime limit on one of the exceptions, and I think it's a 1.1 or 1.2 for the 15-year, were not affected by this, the changes they made to the concessional and non-concessionals, because the small business CGT concession was a contribution in its own right. We now have the fourth type of super contribution, which is the downsizer super contribution, and it is not affected by any of those other rules.
All right. Wolfgang's question, and again, I think we've largely answered it, but Wolfgang's single. He's looking at the downsizing legislation, but rather than putting the money into his super, but there's no obligation to actually have to buy another property. You can do whatever you want. You can go travelling around and living in hostels if you like.
They've called it downsizer because that's probably what most people will use it for. But you can sell your house, never buy another one. You could sell your $1 million house, buy a $2 million house. There's no actual requirement for there to be any downsizing at all. There's just no mention of it whatsoever. So, do that. Go overseas. Sell your house. Go overseas. Rent. Go and live in a tent, caravan park. Buy a bigger home, whatever. There's nothing said anywhere about you actually having to purchase another home or have any other style of housing accommodation afterwards.
Yeah. And interesting, when I was talking with Bruce about this before, the light bulb went over my head with a particular strategy that you could have a situation where the couple do want to be carried out in their box from their place, but finding it tough because they don't have much in the way of retirement assets, and they're on the full pension at the present. But was it $38,000 a year doesn't get you too many overseas trips, or maybe even grey nomading. You could have a situation where a family member buys out the couple. They make a capital gains tax-free gain. The money goes into super. They rent from their person who's bought it. They are now non-homeowners, so their assets test and income test increases. They get rent assistance, and they could be a lot better off as a result.
And they don't have to move out of their home.
That's right. So this is why
they're not downsizing. They're not actually doing anything like that. It's possible to do that. The son or the daughter buying the property, or
very flexible in that way.
Yeah.
Well, that could very well be a good strategy. Brian's got a question.
Sorry, just before you go on to that, though, what we did discuss, though, is that the son or the daughter, if they happen to be the purchaser, instead of having and mum and dad live for another 10 or 20 years, they would have had another 10 or 20 years worth of capital growth in the property that would have been CGT free, whereas if the son or the daughter have bought it and they do live for another 10 or 20 years, then they've got this asset that is a capital gains tax asset. So that's the downside for whoever the purchaser was. If it happened to be the son or the daughter who would have inherited the property anyway. But it's another potential strategy that could make sense, for people in some situations.
It could also work very much that I know that there are some people that in families, and I know more than one, numerous examples of where one of the children, or if there's only one, if it's an only child, say, I would like to end up living in mum and dad's property. Right? In other words, I always loved it there. It's a great location. It's in a city, whatever it may be, the reasons. It could make it a lot better decision to do that. And then, therefore, what they do is they go, they end up with their rental property. The mum and dad end up being financially better off. They've got some possible gearing benefits from doing that. And then when they sell their residence, when mum and dad are gone, they move into the place. And then, there's going to be lots of flexibility in this, depending on what someone wants to achieve.
All right, well, the next question's from Brian. He's got an investment property outside of his place of residence, taking advantage of this legislation and essentially just transitioning into the investment property as his new principal place of residence. Any issues with that?
As long as he's
being able to do that?
Well,
he's got to wait 10 years.
he'd have to.
As long as he
he's
qualifies.
selling his old home that we're assuming he's been in for 10 years or so.
I see what you mean. So he's going to move into
move into the investment property. There's no. You'll get the $300,000 so long as you do after July 1, and you'll be able to do that. You move into your investment property. Depending on how long you've held the investment property for, if you do eventually sell it, you may get partial. You'll get a partial CGT relief for the proportion of time that you've been in the investment property. So it can make sense. I can't see any massive issues.
It's actually perfect. And in fact, because I know, again, in the professional work I do, talking to people, is this going to be your place? Do you want to always live where you are? Do you want a tree change? Do you want a sea change? Do you see yourself living somewhere else? Especially for people, they may even be in their late 30s, in their 40s. The strategy, a very simple one, has been, well, why don't you start looking in the places where you might like to live? Recognise that I am buying that well. Buy it at today's dollar values. And in 25 or 30 years' time, when you might be shifting in there, you will have had your principal place of residence that's gone up in value, and you'll be able to use those proceeds to pay off the investment loan, and you'll have a chunk left over that you can invest. If that was, inevitably a part of that strategy was you must do this before you turn 65. In that instance, I'll now be able to say to people, do this, means there is no clock running on this. You can do it when you're 65, 70, and just because you've done it doesn't mean you have to shift into that place. It may end up that you'll sell it anyway, but it just means that therefore you will be able to use the downsizer super contribution at any stage after you've retired if you decide to move into that property. So, it's a great way of doing it, and that's where, depending on whether the person who's asking the question, if he bought this property with a view to one day maybe shifting into it, it's perfect.
Yeah. Excellent. I think a lot of people might be looking at that if they've got investment property. Sally really sort of covers off the bad cop stuff, which we've talked about a bit, but the costs of downsizing, and again the aspect relating to the assets test on the pension. So I guess she's just asked for our views on it in terms of the costs of selling, and then the impact on the assets test.
You're going to have whenever you sell, wherever you sell. Look, there's some cheaper options out there nowadays, but roughly count on 3%, 2.5% to 3.5% for the cost of sale of your property. Depending on where you are in Australia, somewhere between 3.5% and 5.5% in stamp duty on the purchase of the new place. You get your $300,000, possibly $600,000 for a couple into super, which is great. It'll be in there and paying tax at no more than 15%, hopefully at zero. Both that $600,000 or the $300,000 that you've got into the super fund, plus whatever's left over that you couldn't get into super, becomes an assessable asset under the assets test, and will have an impact on the pension, or probably will have an impact on the pension you receive. Max said a little earlier he's going to have a look at this in the coming weeks as to what $100,000 or $200,000, $300,000, or in $100,000 increments. Find out sort of what impact that's going to have on your pension, on your age pension. So, as all three of us have said, if you're considering doing this and you're at the margins of things like the age pension, you've got to get advice before you go ahead and do it. Pay for the advice, whatever it is, but make sure that you're aware of the financial implications of doing this for you, because you're probably not going to have thought of all of them.
Yeah. I think picking up on, is it Sally was asking?
Yeah, Sally.
I think it's not the sort of thing to do purely to get extra money into super. It's something to consider if you are considering selling at some time in the future. And if you're wanting to do it to get more into super, and it's the only way to do it, definitely you've got to get the advice as to, are you going to be better off doing it or staying where you are?
Yeah.
It's a numbers game. In the end, that's the beauty about a lot of tax planning and financial strategy issues. This is the after-tax dollars you're producing on this scenario. Here's the after-tax dollars you're producing on that scenario. Which is better? And it's just taking into account effects on pension, effects on tax payable on income, all of the rest of it.
And just one more question here. We've had the questions a little bit shorter today because of our technical problems. But Reinhold asks, and again we've covered this off, but if the contract date for the sale is after June 30 this year, is this the date for the sales contract or the settlement date? So I would think if it's after June 30, you're in the clear anyway.
No.
No?
So what are you saying? The settlement date or the contract date?
Contract date after June 30.
That's the contract date must be July 1 or later.
That's right. Yeah. So if it's after June 30, it's July 1.
Yeah.
Yep. Yeah. So in the clear on that. Okay. Well, that wraps up the questions. Any last comments on this? We've covered off a lot of ground today.
I think the important thing, which I think we've covered, is that this should not be a reason to go and sell your home to get money into super. If you were considering doing it, this becomes an extra carrot for people who are really quite borderline. It might be something worth revisiting to see if it is worthwhile. But if you don't want to move, if you want to stay in your home, there's a whole bunch of reasons why this shouldn't have any impact on a very big portion of Australians. But it is more enticing. It is a financial benefit, and it will have an impact. It will get more people to downsize. It's just how big that increase will be. I don't think it'll be enormous, but it'll be of some benefit to people who were going to do it anyway or were borderline.
Yeah,
I agree, and it's the sort of thing that it's always been important to let people consider and think about. What is your long-term position on your current home? And don't be put into the position where you are forced to shift because of health reasons or something like this. Anticipate it. By the passing of this legislation, there's some extra benefits in actually thinking about this a bit sooner and considering what the options are going to be and actually looking at it, okay, how much better are we going to be off if we do this? There are some people that say, no, I just want to be carried out of this. That's it. I don't want to do anything. I'm going to leave this to the kids and that's the end of it and this is where I'm going to die. If when you look at it and if the person's happy to have a substandard of living as a result of it, fine. But if by having the ability to do something that's going to improve their last years and have a better quality of life and all the rest of it, this is another reason for going through that process.
All right, gentlemen. Well, thanks very much for joining me again today.
Pleasure.
Pleasure, Tony. Thanks.
If we didn't get to your questions today, we will answer them. So please feel free to send through questions to us and we'll direct them through to either Max or Bruce and we'll get back to you as soon as possible. Thank you for joining us.